All right, let's talk for a minute about the traits of the best stocks. Okay, so we have to just accept these things as being true in order to follow the system. And these are things that I've learned over time or from various mentors, and they've helped me tremendously. And they've helped me with both long-term investing and options trading. So every single stock that I options trade with has many of these traits. Not all of them, but many of them. The one exception I'll make on options trading is that the stock does not have to pay a dividend, but the best stocks do have dividends. So we're going to get into that in just a second. But the first thing that you need to accept, and it's potentially the most important too, is that the best stocks are expensive. Which is fairly annoying, right? Like, who wants to buy a stock that's $400 a share when you feel like you can get, hundreds of shares for something that's $5 for the same amount of money? I can tell you right now, if you are thinking that way, if you are thinking, I would rather have a bunch of shares at $5 a share than one share at $400 of, say, Microsoft, you're making a huge mistake. Because cheap stocks are cheap because they aren't worth much. The companies aren't worth much. You have to let that sink in. I had to let that sink in and just accept it as a rule of thumb. There are just certain things that happen on the market, and one of those things is that we also have to come to accept that institutions and institutional investors hold all of the power on the stock market. Retail investors don't really have any power at all. And so who are institutional investors? You're going to hear me talking about them a lot. They're so critically important to my investment plan, and they should be known to anyone who's going to invest in individual stocks that they are huge players in the game, and you can't work against them. You never want to work against institutions. You always want to work with them and do what they're doing. So an institution would be like an insurance company that can buy millions of shares of a stock at a single point in time. A college endowment, like down the street from me, we have Northwestern University, which has billions of dollars in their college endowment. It's insane. Most of the big universities have this kind of money now, and their money is invested in the stock market. They have money managers that are buying and selling stocks for them to increase the amount of that endowment. They're super powerful. Another institution would be sort of like the companies that buy and the fund managers that buy shares for ETFs. So they have certain rules that they follow, okay? And they have the power to push stock prices up or down because they can buy millions of shares of a stock at a single point in time. So if you, for example, see Apple go up $2 a share, that's because the institutions pumped more money into that stock that day. If you see Apple coming down $2 a share, it's because the institutions pulled money out of Apple and the stock fell. Retail traders have no ability to make that happen. Only in meme stocks, which is like something we're never going to get involved in, something I never get involved in. So take that question out of the equation and just know that when I sell 100 shares of Apple, it makes no effect on the stock price whatsoever. I'm just a retail trader. But institutional investors, when they buy or sell, they push the stock higher and they can push it lower by selling as well. So we always want to move along with the institutional traders and do what they're doing. Institutional traders don't like buying stocks that are less than $100 a share because they recognize that stocks that are under $100 a share are companies that haven't proven themselves enough over time with their earnings, revenue, and other financial information to draw in more institutional investors to pump that stock price even higher. Today is like June 3rd, 2024, and there are some exceptions to this rule coming up, and this will be exception to this rule in general. There are a couple of interesting stock splits coming up. One of them is NVIDIA, that is currently trading at 1,000 a share or more, and that's going to have a stock split where it might be about $100 a share for just a very limited point in time. That's fine. We're not worried about NVIDIA. Like, this is an exception to the rule. Chipotle is another one. I think Chipotle is going to have a stock split where it's going to be worth like $50, $60 a share. exception to the rule. It came from being $3,000 a share, and there's a stock split. So stock splits are this point in time where we can sort of ignore this rule of it being of buying stocks that are less than $100 a share, and we can indulge a little there. Okay, so like I would indulge there, and I would get behind that idea. But in general, like SoFi, if it's trading at $8 a share, and it's been trading at $8 a share or $5 a share for 2-3 years now, it's because SoFi is worth as a company $8 a share. Compare that to Apple, that's been trading between $185 and $195. That's because Apple is more valuable. So we want to buy valuable companies. We don't want to buy companies that aren't valuable. The institutions notice that, and they are determining actually who is valuable and who is not by having stock analysts and industry analysts that are making really, really great choices based on sound data, not just hunches and speculation like retail traders tend to do. So there's only one other point I want to make here on why don't the institutions buy stuff that is, less than $100 a share? Why do they buy these things that are $200-$300 a share, $500, $700 a share? And the answer is really just because they can. If you have billions of dollars, it's no big deal if you're buying stock for $700 a share. You have that kind of equity. You have that kind of money laying around. If you're a retail investor, perhaps you do not, So I liken it very much towards like buying a Toyota Corolla or buying a BMW. If you're buying a car and money was really no object, what would you buy? You'd buy the BMW because it's a better car. It's better quality. And I don't think anyone would argue that it's not. So they can buy the really nice stuff, so they do. And you also, and I also want to buy the really nice stuff because that is the stuff that's going to give me a better return over time. So these are just ideas that we have to let sink in and accept them for being reality because it's the reality. The best stocks pay a dividend. Okay, so stocks pay a dividend because they have profits to pay their shareholders. Dividend stocks attract institutional money to them because they're generally more stable. Dividend stocks, when there is a pullback, there's less of a pullback in a dividend stock versus just a growth stock that does not have a dividend. So that is one reason why. The other reason why is because institutions can oftentimes only trade dividend stocks. They are bound by the terms of their agreements and certain rules and regulations that they can only trade dividend stocks. You say, why is that? And one of the reasons would be because, let's say Apple had a bad quarter and Northwestern's money was invested in Apple. Well, if they own 50 million shares and a quarter just passed and they get a dividend, that's still like some money that they're getting. And they're interested in those dividends. Collecting dividends is part of their core strategy. Okay, it is difficult to find dividend stocks that trade under $100 a share. So when you add up number 1 and number 2, you can start seeing that there's a pattern here. The best stocks are expensive and the best stocks pay dividends, and none of the stocks under $100 a share tend to pay much in dividend. The exception would be high yield dividend paying stocks, which is not something that I'm going to cover off on here. I am not a dividend investor. I am a growth investor. So if people want to go in the comments and talk about dividend stocks, high yield dividend stocks, be my guest, but that's not what this particular video series is about. The next part of my system is that I buy stocks that have green charts. This is like my core fundamental rule, because I will make an exception to buy a stock that does not pay a dividend or trade a stock that does not pay a dividend, but I will absolutely not buy a stock that does not have a rising 5-year, a 1-year, and a 3-month chart. If any of those charts are red or show some weakness, there's no way I'm buying that stock. If I'm interested in the sector, I might continue to watch it and see 2 years from now if all of those stocks turn green because it's like a growing company or something like that. I will give that time to watch the stock, but I will not buy it. I will not buy it. This rule that I follow keeps me out of so much trouble. You have no idea until you start practicing it yourself. You'll see how this is just, it's great. It's a great rule. The last rule is that the best stocks have great earnings. They have great earnings every quarter. They have great earnings every year over year. And so if they don't, there's a problem in the company or a problem in the industry or the sector that that stock is in that they're having to reinvent the wheel for, or develop new technology or new products and services to service. And that takes a lot of time for a company to potentially turn those types of problems around. I don't want my money invested in companies that are having problems. That's not my job as the boss of my money. My job as the boss of my money is to make sure that my money is in the best companies. So when I follow all these rules and add them up as a system, it really helps guide me as to how to find the best companies.